Hi everybody, and welcome to a very exciting auditing segment where I'm going to show you just how easy it is to think about ROMM and substantives so that when you see a 19-mark question, you go, yes, I have got this in the bag. So we're going to be taking a look at this ITC paper. And the first thing we need to do is dissect our required. So the required says, discuss with reference to the external audit the risk of material misstatement related to the right of use assets. It's very specific to right of use asset only. And then the substantive procedures we need to perform to verify the right of use assets. Okay, so again, very specific to only right of use asset. Very importantly, there is a scope exclusion. Do not address presentation and disclosure in your answer, which means that any risks, any procedures relating to presentation and disclosure are going to be out of scope, so do not even mention them. Right, now let's first break down risk of material misstatement. Okay, so now we need to think about what that means. Okay, so remember that we have two different types of ROMM essentially. Okay, we can have our ROMM at overall financial statement level, and we can have ROMM at assertion level. Now, both of these follow a very similar format. Okay, so they follow the format of trigger and effect. So essentially, your trigger is your inherent risk factor that is coming from the scenario. Okay, it could also be your control risk. Remember, we can have control risk or inherent risk. So it's either our inherent risk or our control risk, and it's coming directly from the scenario. Whereas the effect is essentially what could go wrong. So when we are looking at ROMM at overall financial statement level, the what could go wrong has to be linked to the financial statements as a whole. However, when we are looking at ROMM at assertion level, we are just looking at a specific line item. Okay. And I'll never forget, I always used to be very confused by this term line item. What on earth does that mean? So essentially, it means we've got our financial statements. So let's say we are now dealing with our statement of financial position. And essentially, we've got assets, and under assets, we've got PPE, and we've got cash, and we've got right of use assets. Okay, then we're also going to have our liabilities, and so on. So obviously your ROMM at overall financial statement level has to speak to this as a whole. The entire set of financial statements, including profit and loss, including cash flows. Whereas your ROMM at assertion level is sort of taking a magnifying glass and just zooming in on one specific line item. So one element in one of those sets of financial statements. Okay, so in this case, we're dealing with the right of use asset. So here we have to add a little extra step to our ROMM discussion. Okay, so we essentially have to link that to an assertion. So for assertion level, it's trigger plus effect plus assertion that's being affected. And I know you guys are going to come for me and you're going to say, but I don't understand assertions. And that's exactly what we're going to take a look at. Okay, so if we go back to our scenario, we need to essentially find triggers and we need to link them to an effect for the right of use asset only. Okay, it's not anything to do with the lease liability, although this is where you have to think about your accounting, right? Because ultimately, the calculation of your lease liability is going to influence your right of use asset because we're going to take the present value of all the future lease payments, discounted using the rate implicit in the lease, or the incremental borrowing rate if that's not available, and that's going to be the first input to determining our right of use asset. So let's actually go and have a look at what they tell us in the scenario. Okay, so at the beginning of all of this, they tell us that the financial team consists of experienced and inexperienced staff members. That is definitely a risk factor, okay, an inherent risk factor because we have inexperienced staff members on the financial team. Now I'm going to direct you to a very, very useful part of ISA 315. Okay, and that very, very useful part is good for inherent risk factors. And that is in Appendix 2 of ISA 315. So if you go to Appendix 2 of ISA 315, remember it speaks specifically to inherent risk. We can also have control risk, but this appendix deals specifically with inherent risk. So it speaks about complexity. Now, isn't that interesting? Complexity in the regulatory environment, in the business model, in the financial reporting framework. And isn't that something that we could say is true about IFRS 16? It's quite complex. Okay, so now we've kind of found two triggers. We've got inexperienced staff and we've got our complex financial accounting standard. It goes on to give quite a few. So there's subjectivity, there's change. They speak about change in markets, okay, or the business model, the geography, which is expanding into new locations, human resources competence. Isn't that interesting? IT, uncertainty, susceptibility due to bias or fraud. Okay, and then there's a little paragraph underneath that speaks about other events or conditions that may indicate risks of material misstatement at the financial statement level. Okay, lack of personnel with appropriate accounting and financial reporting skills. Isn't that interesting? So this lovely book, this lovely appendix in this lovely ISA tells us what to think about, what triggers to essentially be looking out for in the scenario when we are reading so that we can link that trigger to an effect. Okay, so just a little separate aside. So we have ROMM, and if the question just asks for ROMM, then we're going to talk about overall financial statement level, and we're going to speak about assertion level. Okay. In this case, they said ROMM for a specific line item, so we're going to speak about assertion level. But did you know you can take overall financial statement level triggers and make them assertion level? Now, let me illustrate what I mean by that. So let's go with one of everybody's favorites, the JSE listed. Okay, this is a trigger in the scenario, okay, because obviously that's a regulatory environment. If you look at this list of inherent factors, okay, high degree of complex regulation, that's obviously the JSE. There's lots of complex listing requirements, and obviously companies then have an incentive to want to stay listed, right? So if we word that at overall financial statement level, then it's going to look like there is a risk that management, and you can try and think of the risk as I'm writing it out. I should have thought about this better. Management may overstate assets and incomes and understate liabilities to maintain its listing status. Now, remember, you have to link that to the trigger because what is the thing that made me think that this could happen? Due to the entity being JSE listed. Okay, and I'm really hoping that this writing is showing up. Let's maybe just zoom in a little bit. Okay, so that's overall financial statement level. We have linked this to the overall financial statements, or the financial statements as a whole, rather, because we've spoken about overstating assets and incomes and understating liabilities. We're speaking to multiple line items in the financial statements. But if we were to make that an assertion level risk, and let's just make this slightly thicker. If we were to make that an assertion level risk, in this case, because we're dealing with the right of use asset, now we're going to have to say, and let's switch it up a little bit to show you that more than one way of writing something can be correct. Okay, so let's start with the trigger. Since they are JSE listed, management has an incentive to overstate the right of use asset to maintain the listing status. Okay, now I've turned it into an assertion level risk, but what did I say earlier? I said that with assertion level, yes, we've got trigger, yes, we've got effect, but it has this extra piece. We have to link it to the assertion. So now I'm thinking, okay, overstate assets. If I overstate assets, I could be doing one of two things. I could be manipulating the values, which would speak to accuracy, valuation, and allocation, or I could be including fictitious right of use assets. So I'm just going to write here existence. Okay, so in the event that a question asks you for a risk of material misstatement at the assertion level, you can still take overall financial statement level triggers and you can just change the wording slightly. See what we did? We went from overstating assets and incomes, understating liabilities, to just mentioning overstating the right of use asset, the specific line item that we are trying to assess the risk of. Okay, hope that makes sense. Okay, so that was a little aside. Okay, so now we've already identified that we've got two triggers essentially. Okay, let's use a different color here. Let's use purple. Okay, so we have identified that we've got inexperienced staff for one. And we've also looked at that Appendix 2 in ISO 315 and discovered that IFRS 16 meets the definition of a complex accounting standard. We know it can get quite hectic. Okay, there's discount rates and present values and all sorts of things and recognition exemptions, or what's the word I'm looking for? Practical expedient. That's the word I'm looking for. So let's find a way to try and word this. Okay, so if I go back to my scenario, I can see they have a specific note, which I identified during my reading time, that speaks to the right of use assets. Okay, so now I can see, they've got new leases that are entered into. Okay, so we know that there's possibly a chance that those weren't recognized correctly. Same with the derecognition, same with the depreciation, same with the impairment. Then they speak about assessing whether a contract contains a lease. Okay. If it meets the short-term or low-value asset definition, then we're going to obviously recognize it a bit differently. Okay, they speak about present value of lease payments discounted using the rate implicit in the lease. Okay, initial direct costs. Well, what if those are capitalized incorrectly? Okay, we speak about impairment. Impairment is only on land and buildings. That's interesting. Right of use assets are located throughout South Africa. Okay, that's interesting. Now I'm finding all of the things that can go wrong. So essentially, I am finding the effect piece, but I need to link it to a trigger. Because if you just write, there is a risk that new leases entered into aren't correctly recognized, and even if you link it to completeness, we'll speak about assertions now, you're still not going to get the mark because you've got the effect, you've got the assertion, but you haven't linked it to a trigger. You haven't linked it to the thing that's making you think that something could go wrong. So in this case, let's use the inexperienced staff members. And I can link that to quite a few points, and I can link the complexity to quite a few points. But I don't want to keep writing that all the time. I want to write due to inexperienced staff 67 times. Okay, so I'm going to write due to, oops, why are we not writing? There we go. Due to the inexperienced staff, the following risks arise. Okay, so now I've sort of grouped my trigger and I'm going to list the effects associated with this inexperienced staff. So if I go back to my scenario, first thing we're going to take a look at, and this is where we want to understand our assertions. Okay, so new leases entered into, and this is going to help you with your substantive procedures as well. What we're going to do is we are going to draw a little T account. So we've got the right of use asset. Okay, with our right of use asset, we can see there's an opening balance. Cool. So we've got an opening balance. Then we've got additions. Okay, and those additions are, of course, calculated using the present value of the lease liability and the interest rate, right? Discounted using that interest rate. Then we've got disposals, because that's what we saw in the information. We've got depreciation, and we've got impairment, and we've got closing balance. Great. Okay, so we've thought about the accounting, and that's going to help us with the auditing, because auditing and accounting, they are kind of besties. Okay, so let's think about the assertions now. We are looking specifically at the new leases that are entered into. Okay, so if there's a risk that they haven't been recognized, which means there's a risk that we haven't said debit, right of use asset, credit, lease liability. So if we haven't processed this journal entry, it means that the value of this right of use asset is essentially too low. And everything that should have been recorded has not been recorded. So that's going to affect completeness. Let's think about the disposals. So with the disposals, maybe the lease has ended. So we debit the lease liability and credit right of use asset. I might be wrong here, very likely. Okay, but essentially we need to remove whatever's left of that right of use asset. We don't know if it was terminated early, so the journal entry might look slightly different, okay? So now it means that this wasn't processed, which means that if it hasn't been taken out of the right of use asset, then the amount is too high because there's still a lease in there that's no longer our lease, no longer our right of use asset. So we need to take it out. And essentially, that does not exist. Okay, and then of course we've got depreciation and impairment. Those deal with values. Those ones are very nicely linked to accuracy, valuation, and allocation. Okay, so those are your assertions. And then we'll speak about some more as we work through the rest of the information. Okay, so we will then list our effects because we're linking it to our inexperienced staff. Okay, so there's a risk that a new right of use assets have not been recorded. So we've got trigger, we've got effect, but this is an assertion level, so we need an assertion. So we spoke about that. It's going to be completeness because now there's stuff missing that should be in there. So not everything that is recorded has been recorded. Okay, similarly, if we look at the disposals, okay, disposals of right of use assets have not been de-recognized. Okay, so now we can link that to existence because if it hasn't been de-recognized, but it should have been de-recognized, essentially it doesn't exist. We don't have that right of use asset anymore. Okay, you could even link it to rights. We no longer have the rights to it, so it shouldn't be there. Okay, so these things can affect more than one assertion. That's also important to keep in mind. Okay, then if we take a look at the depreciation and the impairment, right? So now we can say, okay, could be linked to the inexperienced staff, sure. But also, if you think about depreciation, it's going to be based on the value of the right of use asset, which is based on the value of the lease liability. So I'm thinking maybe complexity of IFRS. So I'm going to write here, due to the complexity of IFRS 16, the following risks arise. Depreciation is not calculated accurately. Can now see how I have written out the assertion. So now I don't need to link it to an assertion because I'm not saying depreciation is not correct because then I need to link it to the assertion. What aspect of it is not correct? But here I'm specifically speaking about accurately. which links to the assertion of accuracy, valuation, and allocation. Okay, same thing with impairment, except that's going to be in terms of IAS 36. Okay, that might be more complex as well. Okay, then we've got more things in the scenario to work with, right? Because they speak about here, assess whether a contract contains a lease. Okay, so maybe due to the inexperienced staff members, they might incorrectly assess that the contract does or does not contain a lease, right? Then that could speak to rights potentially, or it could speak to existence, or it could speak to completeness, depending on which way you go. Because if they have incorrectly assessed that it does not contain a lease when it should contain a lease, then the right of use asset is going to be incomplete. Similarly, if they conclude that it does not contain, it does contain a lease when it actually doesn't, then the right of use asset does not exist and we do not have the rights to it. Okay, I'm not going to write all of them because we'd be here all day. So I'll just speak you through the rest of the triggers. Okay, they speak about short-term leases and leases of low value assets. Okay. So this is now obviously the practical expedient for IFRS 16. We can again link this to the inexperienced staff and say that they might incorrectly classify it as a short-term lease or a low-value asset. If it's been incorrectly classified as that, it means that there should be a right of use asset that is now not there and it's going to be incomplete. So we link it to completeness. Okay, the lease obligation is initially measured at the present value of lease payments outstanding at the commencement date. So similarly, now we're going to think about accuracy because we're dealing with a number, calculation. So there's a chance that due to the complexity of IFRS 16, the present value of the lease payments outstanding is done incorrectly, or another effect is we use the incorrect discount rate. And we're going to link that to the accuracy, valuation, and allocation. But very, very, very importantly with this one is you have to link it to the right of use asset. You cannot say the lease liability has been calculated incorrectly because the required asks you for right of use asset. So you need to know your accounting here because you need to know that that is the first step in determining the value of your right of use asset. And then the next step is to capitalize any initial direct cost. Okay, cool. So now there is potentially a risk that costs that should have been capitalized to our right of use asset have not been capitalized. That can speak to accuracy, that can speak to completeness. Okay, or we could say there's a risk that costs that should have been expensed have been incorrectly capitalized. That can speak to existence because that cost doesn't exist as part of the right of use asset, or it could speak to accuracy, valuation, and allocation. Okay, so I hope that this is making sense. And then with the impairment charge, there's a risk because it's only on land and buildings. So there's a chance, because we have these inexperienced staff members, that there should be impairment recognized on other right of use assets as well. Okay, and then the right of use assets are located throughout South Africa, could potentially link that to a control risk, that the controls are not applied effectively or consistently across all of the different locations. Okay, and then that one you could link to basically any of the assertions. Okay, so I hope that helps with ROMM. Now let's talk about substantive procedures. And again, we are going to use this very lovely T account. Okay, so with substantive procedures, you are essentially thinking, and in this specific case, if we go back down to the required, we just need to remind ourselves of what it's asking. Substantive procedures. So when we see substantive procedures, we can think of analytical procedures, if applicable, and we can think of our tests of detail. And now with our tests of detail, we need to use an audit verb. Okay, and those audit verbs are inspect, observe, reperform, recalculate, and inquire. Okay, inquire has to be corroborated. What does that mean? It needs to be supported by evidence from one of these other procedures. Okay, So you either have to inquire and inspect something to corroborate that, or you have to reperform something or recalculate something to corroborate whatever you've inquired. Okay, so that's the first thing. And then, if anybody's seen my TikTok, you know the grievances I have with this one. Confirm, which is only for external confirmations. So in this case, we would be able to use an external confirmation because we could send an external confirmation to the lessor, right? To confirm that we are in fact leasing this asset from them. And their calculation would be a little bit different to ours in terms of lessor accounting, but it would tell us about the existence of that right of use asset. Okay, so we need an audit verb, and that audit verb is essentially being performed on something. So like a document, or maybe you're talking to a person. Okay. And then we have to have a reason why we are doing this. What are we trying to get comfort over? And that's usually where we link it to the assertion. Because remember that these procedures are in response to the risks that we've just identified. So the procedure that we are performing is giving us comfort over a certain risk, right? That's the whole reason why we do auditing. It's a risk-based approach. Okay, so if we take a look, keeping in mind our structure and keeping in mind that we could probably do analytical procedures here because we have an opening balance. Okay, we could probably do some opening balance, analytical procedures here. Okay, because they've given us information to compare to a prior year. Okay, so it might indicate that there's potential other evidence we could get from doing the analytical procedures. All right. So let's think about our substantives. So for each item in the T account, because we are not limited to specific assertions, and that's really, really important. They just said to verify the right of use assets. They're not limiting you to certain assertions only. They're saying go wild, but do not address anything to do with presentation and disclosure. So now we want to think to ourselves, where can I get evidence for each of these things? Where can I get evidence for the opening balance? Well, if they have prior year audited financial statements, you could inspect the closing balance of the prior year audited financials, agree it to the opening balance to ensure it was carried forward accurately. Accurately. See, there's my assertion. Now I want to think, where can I get evidence, firstly, of the additions that they are actually a real thing? And how can I make sure that they have been calculated accurately? So here I'm thinking about the additions, I'm thinking about the evidence, and I'm thinking about the evidence in terms of how can I prove that this exists? How can I prove that it is calculated accurately? So I'm thinking in terms of the assertions because these are the things I want to get comfort over. And this is a nice easy one. Where would we get evidence for a new lease? And I'm hoping everybody's saying inspect the new lease agreement or agreements for the following. And these are easy marks that you guys often sacrifice. Okay, so first thing, nice obvious one, names and signatures. But my purpose, I have to say what I'm trying to get comfort over here, which is going to be rights. Okay, because it's going to tell me if I have a right to this right of use asset. Can I actually put it in my books? I might look for commencement date. Okay, and commencement date is also going to tell me about rights, or it's going to tell me about existence. Again, these things can speak to more than one assertion. I might look for the lease payments. Okay, that's going to tell me about accuracy, valuation, and allocation. Because I'm now going to use these lease payments to recalculate the lease liability at the commencement date. And why am I doing that? I need to link that to my assertion, which is going to be accuracy, valuation, and allocation. Do not abbreviate. I'm just doing it in the interest of time. Okay, so you see how the thought process goes. What am I looking for? Why am I looking for it? How can I use it in another procedure? Okay, and it helps to think about your T account, right? Now, you can test the present value of the lease liability by recalculating it, and now you've got proof of the lease payment from the lease agreement. So, yay, we're happy. But this I, that I, you are not going to find in the lease agreement. Okay, you are probably going to have to try and recalculate the rate implicit in the lease. Okay, because it's not going to be something that you can get external evidence from. Or maybe if you look at similar lease agreements, if they have a similar implicit rate in the lease. Okay, so that one you need to think about a little bit more carefully. All right, then if we look at the next one. Okay, so, oh, another one to think about for additions. How can I make sure that this right of use asset is real? Well, it's a physical, tangible thing. I can physically inspect. Okay, see how I'm using those audit verbs. Audit verbs are what's going to get you the mark, and linking it to the assertion, please, please, please. Okay, I want to speak about depreciation and impairment quickly before I finish off. Okay, so depreciation and impairment, I refer to them as outputs. And an output is something that you can recalculate. But that output is determined through different inputs. So with depreciation, for example, specifically in the context of IFRS 16, okay, we obviously are going to have our carrying amount for our right of use asset, which we're going to have tested already. Then we're going to have the term that we depreciate over. And that is usually, I think it's the shorter of the useful life of the asset and the lease term. So we, as auditors, are going to need to make sure that they have used the correct term, because otherwise their depreciation is going to be incorrect. Okay. Same thing with impairment. We have a carrying amount, which we would have tested, but then we're going to have our recoverable amount. And I think for IFRS 16, there's something very specific that there's only a value in use. So we can then test that value in use. Okay. And IAS 36 tells you how to determine that value in use. So you can think about procedures to go and test each of those elements of the value in use calculation. Then once you've tested all the inputs, you can recalculate the output. Okay. And then thinking about the closing balance. How can I make sure the closing balance is correct? Well, that's where I'm going to cast and cross-cast for mathematical accuracy. And remember, this is all done before we even think about the general procedures, or maybe the more obvious procedures like, where can I prove that lease payments have actually happened? Because maybe I'm not just happy with the lease agreement. So how can I prove that these lease payments have actually happened? Well, there's kind of like two ways, right? Because now you can inspect the bank statement, because the bank statement is an external source document. Management can't manipulate it. As the auditor, we can get it directly from the bank. Okay, so we can inspect the bank statement for those lease payments, and that's going to give us comfort that they actually exist and that we can actually use them to recalculate the lease liability, okay, which is going to be part of our right of use asset. Okay, we can also send out an external confirmation to the lessor. Okay, to confirm that these lease payments have in fact been made and that they have in fact leased this asset to the company that we are busy auditing. Okay, so you can see how easy it is to come up with 10 marks. So 19 marks shouldn't be intimidating. And then there's one for free in there if you get the wording right. So don't let a risk question or a substantive procedures question ever trip you up again. Think about your accounting, because auditing and accounting, they are besties. And also don't forget, when it comes to substantives, the Companies Act is also featured in there. If you look at an audit report, specifically an audit opinion, they express an opinion on the IFRS application and whether it's been done correctly in accordance with IFRS, and the Companies Act. So if you see a Companies Act trigger, so let's say, for example, this was leased from the CFO's brother, as an example. That's a Section 75 trigger. You need to go to Section 75 and say, how can I prove that these requirements were met? Where will I get the evidence for this? Well, it speaks about the board has to do this before the resolution. So there's minutes for that. I can inspect that. Okay. So I hope that this helped and have a great rest of your day. I will see you guys again soon.